Okay, part three. And we're talking about monopolistic behavior, performance, and that sort of thing today and throughout the rest of this lesson. But as we mentioned before, just to kind of preface or summarize the things that we get out of the behavior of that marketplace is that typically consumers will be charged higher prices. Good, bad, or indifferent, it just is what happens. You can make your own judgments on that. There's usually reduced availability of the product as compared to the perfectly competitive model. But, there's probably a little more stability in that kind of a marketplace as well because it's regulated by one firm. Transfer of wealth from consumer to capitalist. Typically, the monopolist has a higher degree of chance for a profit, and they're typically more skilled at taking a profit out of the market too. So it just profits are actually a transfer of wealth from one individual to another. In this case, it happens to be the monopolists or the shareholders that own the monopoly itself. Okay, so that's what we were talking about as far as performance of those monopolies. Um, the the interesting thing, and we see this a lot, especially small states, small locales or communities, have only one business, and that would be what we would call a geographic type of monopoly. And we've spoken about them in the recent videos and that sort of thing, and I think you could probably point out many of, you are from smaller towns, and there's probably examples of just one kind of firm in that marketplace in the Casper market if you're from Casper as well. I can't think of it right now. I'm from a very, very small town. There's only about 20 people that live within the unincorporated area that we call Hyattville, and there just happens to be, at this time there's one cafe that's open part of the time. There used to be two. It's very, very difficult for in such small locales with very little customers to draw from to actually have multiples of that particular business in order to grow that market. And so what you find is that it's very difficult to be in business beyond just one firm, because once you split in any fractional portion the market share to two or three businesses, there's not enough for any one of them to actually survive. So a lot of times it's just a natural event that one will survive, struggle through the struggles and all that kind of stuff, competition. But again, like I pointed out before, there's no their demand curve still is has a slope to it. So I mean, they can't just charge anything that they can. They may be able to charge a little bit higher price because potential customers are going to be measuring against whether they can go 20 miles down the road or in order to do that, or fix their own meals in the case of a cafe or any other business for that matter. So, a monopolist, even in the highest degree, where there is only one firm participating in the marketplace, still has that sloped demand curve where the amount of output that they can sell is determined by the price in the market. So anyway, those are interesting things to look at as far as that goes. The law of demand follows the price of a good or service. Consumer demand and they buy less quantity of a good or service. And I've emphasized demand within this discussion, and that's why we studied it at the beginning of the semester, is that it's just the relationship between the price and the quantity demanded in any marketplace. And it typically looks like this, where it may be a little flatter, it may be a little steeper, but it'll have a slope where if the price gets high enough, you'll have consumers back off on the amount that they purchase from the marketplace. So that's all that relationship is really that is out there. Consumers typically like lower prices versus higher prices. So when you take a look at, I'm going to get rid of myself if I can here. It's not going to, oh, there, no. It's not going to let me do that. Anyway, I'll try to just pull myself out here. Just a little aside here for those of you in my class. All right. So anyway, if you look at the demand curve for perfectly competitive, we've already shown this. The marginal revenue equals the average revenue. We've determined it. We've proved it, and we've also proved that it is the actual demand curve for the firm that is working under the conditions of perfect competition, that kind of marketplace. Okay, they have no influence over price, and it happens to be the price. In a monopoly, the demand curve is essentially the average revenue curve. And you can calculate the average revenue curve by simply taking the total revenue divided by the output, and that you would get this linear type of relationship. All it is a relationship between price and quantity, and I think that's pretty close to what the definition for demand is. And so when we only have one firm in the marketplace, and as in the case of a monopolist, then the average revenue curve becomes the demand curve. Okay, if they produce more output, the price is typically going to come down, and then if they produce less output, the price is typically going to go up, and vice versa. With if you increase the price, quantity demanded goes down, and if you decrease the price, then quantity demand typically goes up. Okay, so that's how we determine the demand curve, which is pretty interesting in itself. Okay, now what I promised you when we studied perfect competition is that the same things that hold true within that marketplace and the relationship between the firms and the marketplace hold true no matter what kind of structured type of marketplace we have. And we're just talking about a different structure in a monopoly type of a situation in the marketplace. And the key thing to write down in your notes is that when marginal revenue equals marginal cost, that particular firm will actually maximize profits or minimize their losses. Okay, so I'll say that one more time. When the marginal revenue equals marginal cost is when that particular firm, no matter what structure they're in, will actually maximize their profits or minimize their losses. So in saying that, what we want to determine with what information we have is, since we have the average revenue, all we have to do is take the total revenue divided by the total output. Okay, if we can find that relationship, we can find the marginal revenue. Marginal revenue is the last unit of output, the revenue from the last unit of output. And what we find across the board is that we'll get a steeper slope to the marginal revenue. We can calculate that, and I have just a really quick example for you, an exercise that you can do on your own, and I'll provide a link here. I just want you to calculate the marginal revenue, and it already has the average revenue for that monopolist mapped out. I want you to map the marginal revenue, and typically the marginal revenue will follow this kind of case that we see right in front of us, is that they'll have a steeper slope to it compared to the average revenue. So that's interesting because we're trying to find out where the marginal revenue equals the marginal cost so that we can maximize our profits. Okay? So let's go on a little bit farther. So here's the example. All right? You can do it from right here if you want. I'll just breeze on by here, but you can go ahead and figure out what the marginal revenue is given total revenue and output in this case, and then map it out. Okay? Oh. So anyway, I've kind of gone over this part of it. So I'm gonna speed ahead here. These videos, I know they can get a little bit long, and I want to make them as short and possibly as interesting as possible. So again, this is for your notes. Cost structure, and then the profit maximizing behavior, the marginal revenue, where it equals the marginal cost, is where we'll maximize our profits. Okay, so here we've overlaid the average revenue and the marginal revenue on top of the cost curves, because the y-axis is the dollars per unit, or price, or cost per unit of output in this case. So we can compare those. They're apples with apples, dollars per unit. And we can determine from this where marginal revenue equals marginal cost. And if you'll notice, the P star and Q star, if I were to ever ask you from a graph like this and given you a monopolistically set up structure and these cost curves, you would identify Q star and P star as the profit maximizing price and profit maximizing output. Okay? And you can see where marginal cost equals marginal revenue in those cases. Now, if you were to look at this, and hopefully this will be somewhat apparent, but if we were to draw a line right here and look at everything in the rectangle above my arrow here, that would be the amount of profits, since we are right at the cost, the total cost curve. This is the average total cost curve here. Everything up above that is profits. Everything below it is cost, and of course they're separated into variable and fixed costs. Okay, so that's the profit maximizing price and output that the monopolist would want to produce at in order to extract the largest amount of profit out of this marketplace. And they are the only ones in that marketplace. Remember that part of it. Okay. Little pause there, but I wanted you to take a look at this. If this monopolist were to actually decrease the amount of output, okay, there would be less profit. And you might say, well, he's going to produce he or she will produce at this price, so they would make more money. And sometimes, I mean, I don't mean to beat up on government bureaucrats, just that they don't know this relationship too well sometimes. And some do, I'm not saying that. But is the fact that, if they've got fishing licenses or hunting licenses or permits of one type or another, is that sometimes they just think they're going to bring in more money if they raise the price. And we, as economists, actually know that that's not the case. Governments are monopolies in their own right in some of these marketplaces. And if you raise the price, you may actually shoot your foot off as far as your profitability could be, because of the reaction behavior of the consumer to your pricing. And you can see here, if actually I were to produce at this level or raise the price up to here, then this is all that consumers are going to buy. And I'm going to severely decrease the amount of profits that I can extract out of the marketplace. And I could have made the consumer a lot happier with lower prices and sold them more of that output. Okay, so it's not all about, how much I can charge. A lot of times it's hitting that sweet spot as far as the price goes in order to extract the most profit out of the marketplace. Okay, so I just a couple things to go over. In the long run, economic profits will continue to be earned because of the barriers to entry. And this is a key difference between the monopoly and having its own market and the perfect competition that we've been discussing for a whole large period of the semester, is that over the long run, a monopolist can force long-term profits, typically. Okay, there's some examples where they can't, but on the long term, they can actually have more profits over the long run, short run, and long term, and that's critical in the whole structure of the monopoly. And you can kind of see why you should have those sort of things applying to those kind of marketplaces, because as we discussed early on, the capital that's required typically for those huge monopolies especially is outrageously higher than most other kinds of firms have to have to get started and get going and have actually put a product out onto the marketplace. And always keep in mind that as substitutes are developed with technology and all that kind of stuff, I did mention the Yellow Cab company versus Uber. Yellow Cab was absolutely a permitted governmental monopoly in the larger cities. You couldn't be any other kind of cab company. And then all of a sudden Uber arrived, and it was like chaos. And substitutes, when they're developed, can and will take over. The technology is there, and I mentioned it earlier in the semester that you can actually pass electricity through radio waves. Okay, there may, someday, I don't know what it's going to make for us. Might stand our hair on end all the time, but maybe a whole lot better way of transmitting electricity to individual places. And get off the grid doesn't mean you don't get off of the electricity, possibly, and could be where that could be a viable substitute of a distribution for actual power. So anyway, those are just examples. They're probably a wild idea, but many things have been discounted as wild ideas that came to fruition too. So I'm going to hit the pause button. And if you guys have any questions in any of this, it's really interesting to an economist, we kind of come to the stage, and hopefully you're still staying at 20 to 40,000 feet when you look at these things, is that there's real reasons for some of this stuff. Now, and that's not actually talking about, there's always examples of unethical people, unethical cultures within businesses and stuff like that. And I'm certainly not an ally of those kinds of things. But when business is done well, there's a real reason for a monopoly to be in place. And it actually serves customers better than actually if we had, multiple firms within some particular marketplaces. So hopefully that helps you. And we'll hit the pause button.